Let's turn to risk assets now. I want to talk about modern monetary theory, which is a relatively new economic theory that contradicts a lot of classical economic principles. It's being picked up by a few notable investors and politicians right now. Ray Dalio, for example, has written about it recently. And for the viewers, MMT basically states that countries can finance their operations by continuously printing money without really the fear of inflation. So my question to you, and I'll start with you, Peter, is does this theory have any validity? Because a lot of equities bulls are citing MMT as a reason to maintain their long positions in the markets.
Well, first of all, I don't think there's anything new about it, and I don't even think it's a theory because we already know it doesn't work. So there's nothing theoretical about it. I mean, you've had plenty of examples in history where currencies have been destroyed based on what they now call modern monetary theory. Look, the whole idea that you could print all this money and not have inflation, the printing money is inflation. So by definition, you're creating inflation, so you have it. Now, obviously, there are situations where you can create inflation and it may manifest itself in rising asset prices before it ultimately moves into rising goods prices. And if you have a very productive economy that is generating more output of goods, then maybe you can create a lot of inflation without the price of goods going up because you're merely preventing the price of goods from falling, which would have otherwise benefited the citizens because they would have been able to buy more for less. But at the end of the day, what they're advocating is not a free lunch, right? You can't have government for free simply because you print the money to pay for it. In fact, the most expensive way to finance government is through inflation, is through printing money. It's much better to do it through legitimate taxation. But of course, the public will resist taxes, especially when they're already broke, like most Americans are. But this is a panacea for government. They can pretend that they can have this laundry list of socialist programs. I mean, look at what we're doing now. All the bailouts, all the enhanced unemployment benefits, the PPP, right? Everybody is getting bailed out and nobody is getting a bill. Nobody's taxes are being raised. Everything is being paid for by the Fed because we think it's all free because everybody believes in MMT, whether they want to acknowledge it or not. But we're about to see it's going to be a complete disaster because the dollar is going to collapse. And then, of course, what the MMTers don't get is, well, what do you do? What happens when inflation goes out of control? What happens when prices really start to go up? How do you stop it? Once you've let that genie out of the bottle, how do you put it back in? It's impossible.
Jim, what do you think? I mean, quantitative easing has been one of the driving factors behind the equities bull rally. Can you see this stopping anytime soon?
No, I mean, Peter's right. The Fed dug a hole and they can't get out of it. And I said all along, but certainly, 2014, 2015, et cetera, as they did the taper and then they did the liftoff and then they raised rates and all that. I said the Fed is trying to get out of this. They're trying to normalize the balance sheet, trying to normalize interest rates. Normalization meaning they'd love to get rates to around 3.5%, 4%, and they'd love to get the balance sheet down to maybe $2 trillion from a level of $4.5 trillion where it was in 2014 and a level of interest rates of 0. So they had to get rates up, balance sheet down. Why? So they could prepare for the next recession. They weren't forecasting a recession, but they knew one would come eventually. And it takes about 4 to 5 percentage points, 400, let's say, basis points of rate cuts to get the U.S. out of a recession. How do you cut interest rates 4% if you're at 1? Well, the answer is you can't. And that's why they came up with quantitative easing. So the effort was get to 4% rates, $2 trillion balance sheet, and you're ready for the next recession. That's what they were doing. That's what made Fed forecasting the Fed child's play. It was very easy. But I also said they won't be able to do it. They will not be able to prepare for the next recession without causing the recession that they're trying to prepare for. And that's exactly what happened in the fourth quarter of 2018. Between October 1st and December 24th, 2018, the stock market dropped 19%. It was 1 point away from a bear market at that stage. And then you had the Christmas Eve massacre. And that's when Jay Powell threw in the towel. He got religion. He said, okay, first he said, we're not going to raise rates anymore. Then he said, we're on pause. Then he said, we're actually going to cut rates. And then 9 months later, he said, we're going to end quantitative tightening, which was reducing the balance, the money supply. And then in September 2019, they started QE4, which is that was before before the recession, before the depression, before the pandemic. They were already in QE4 and cutting rates again. So they can't get out of it. Now it's worse because they're back to zero and the balance sheet's up to $7 trillion at this point. So they prove that the failures manifest. They prove that they can't get out of it. And what can they do? By the way, on modern monetary theory, I mean, you're right. Peter's right. There's nothing new about it. This comes in a book called The State Theory of Money by Georg Knapp, which was published, I think, in 1921. Might be off by a year, but 2021, somewhere in there. But you say, what's the secret behind money? I think it's garbage, by the way. But you say, what's the secret behind it? Well, the secret behind it is if you can issue debt and collect taxes in the money that you print, you can force people to accept the money because they need the money to pay their taxes. And if they don't pay the taxes, they end up in jail. Now you can get extensions or do whatever, but at the end of the day, if you manifestly refuse to pay your taxes, they will come and put you in jail. And the point is, it relies on state power. It's really a neo-fascist concept. It relies on coercion, the point of a gun, jails, and state power to enforce the confidence in money. Now and they say that. I mean, I've read Stephanie Kelton. She's the bright light. I mean, this goes back a long way, but I've met her, read her books and her book, I should say, and her articles. But they're very explicit about that. Now, I think that's completely wrong because there's so many workarounds and so many ways to get out from under that kind of state power. But they do rely on state power at the end of the day. So that's why it has this neo-fascist element. And beyond that, Stephanie Kelton, who was a professor at State University of New York, was also the chief economic advisor to the Bernie Sanders campaign. Now, Sanders' campaign is over, but Biden, to get the Sanders vote, is basically endorsing the Sanders platform. He has to get the Bernie bros to vote for him in November. If he wins, you're going to see Stephanie Kelton at the Treasury or maybe on the Board of Governors, sitting 5 feet away from Judy Shelton. That'll be interesting. Yes. But this is
that's the only way that they can try to pay for everything they're promising the voters in exchange for their votes. Medicare for all, free college, reparations for slavery. I mean, where's the money going to come from? I mean, we're broke. We're already hopelessly in debt. The middle class can't pay higher taxes. If they raise taxes on the rich, well, they won't collect very much. There won't be much wealth left after they finish taxing it. So the only source of the money is the Fed. So obviously they're going to embrace this theory because it's so self-serving. And, they've been lulled into a false sense of complacency because it seemed that we've been able to get away with it. We have printed all of this money since the '08 financial crisis, and everybody thinks it hasn't caused a problem. Everybody says, look, see, there's no inflation. We printed all this money. The balance sheet has exploded. And look, prices haven't gone up. So they now have this false sense of security that there's no limit to how much they can print. Well, what's basically been keeping us from having to deal with those consequences has been that reserve currency status, has been the willingness of the rest of the world to hold on to that paper in the form of treasury bonds or corporate bonds or mortgage-backed securities or even U.S. stocks, right? So as long as they're willing to park the money in financial assets, then it doesn't bid up consumer prices. But once they lose confidence in the dollar, then they lose confidence in all dollar-denominated assets, and now they want out. And now all that money is going to come rushing back to the U.S., bidding up the price of whatever's not nailed down.
Thanks for watching until the end of the video. The third and final segment of this interview will go live on Monday, August 3rd. It's an exciting conclusion in which Peter Schiff and Jim Rickards debate inflation versus deflation. You definitely don't want to miss this, though. Tune in on Monday.